Bank Holiday Monday shortens the coming week, at least for us here in the UK, and the most important macroeconomic data is likely to come from overseas in the form of the US Conference Board's Consumer Confidence Survey on Tuesday the 26th, and America's Personal Consumption Expenditure Index on Friday the 29th. The latter is the US Federal Reserve's preferred inflation measure, and the rate of increase is higher now than it was last November. That lack of improvement may explain why Fed Chair Jay Powell and the Federal Open Markets Committee are yet to bend to President Trump's call for lower interest rates. On this side of the Atlantic, we have a short list of scheduled corporate announcements, although it does include 3 members of the FTSE 100. Bunzl and Prudential with first half results on Tuesday the 26th of August, and a first half trading update from JD Sports Fashion on Wednesday the 27th. However, even that august trio are likely to be overshadowed by the second quarter results that are due out from NVIDIA after the close in the USA on Wednesday the 27th, so we'll go stateside for the second week in a row. Now, in many ways, NVIDIA matters whether investors own it directly or not. It's the world's biggest company by stock market capitalization at $4.4 trillion as I sit here. It's also one of the Magnificent Seven, alongside Alphabet, Amazon.com, Apple, Meta Platforms, Microsoft, and Tesla. And that septet represents more than 35% of the market valuation of the S&P 500 index and more than a fifth of global stock market capitalization. If you own an index tracker that follows either the S&P 500 or global benchmarks like the FTSE All World, you will have exposure to NVIDIA. Now, the Mag 7 are all in the list of the top 10 largest companies in the world by stock market capitalization, and their aggregate worth at the moment is $19.7 trillion. That price tag puts them on 34 times forward earnings for 2025 and 29 times for 2026, big premium to the S&P 500. Dyed-in-the-wool value hunters may blanch at those multiples, while momentum investors will point out how earnings estimates keep rising, with the result that those ratings could be a bit deceptive. An impartial observer may note with interest how that combined market cap of $19.7 trillion exceeds the gross domestic product of China, and thus the combined efforts of some 1.4 billion Chinese. It's easy to be sniffy about such juxtapositions and brush them aside as optical illusions. Similar points were used to argue that Japanese real estate was overvalued in the late 1980s, when some wag asserted that the grounds of the Imperial Palace in Tokyo had been given an implied valuation higher than all of the states of California. Nobody cared, at least until after the Japanese property and stock market crash of the early 1990s, and by then it was too late. So the trick then is to find out what, if anything, can knock the Mag 7 off their stride. Right now, they, or at least NVIDIA, Meta, Microsoft, and Alphabet, are feeding off the splurge in AI-related spending. The more the last three spend and promise returns from AI, the more the market likes it, and the more NVIDIA likes it, as the company provides the processors and silicon chips that power the data centers that drive the large language models and the effort to develop AGI and, to use Mark Zuckerberg's new word, super intelligence. So, if spending is good, so far as Mark is concerned, then perhaps a slowdown in spending could eventually be seen as bad, either because they've overdone it, or the returns are not there, or at least coming later than expected. Who knows? But if any firm's brave enough to step away from the spending race, it might be interesting to see what those share prices do, especially when we bear in mind that the Wall Street Journal article, which once argued that more than 40% of NVIDIA's sales come from Meta, Microsoft, Amazon, and Alphabet. Thus, both the stock market and earnings are increasingly reliant potentially upon quite a small group of companies, and if there are any stumbles, I do say if, well, then the fallout will be interesting to watch. Now, this takes us back to NVIDIA, which has the happy knack of demolishing quarterly earnings estimates, even if some argue this is because Chief Executive Jensen Huang is smart enough to sandbag the forecasts. The company even managed it in the first quarter, despite a $5 billion charge relating to the loss of revenues in China thanks to President Trump's tariffs. The shares have been on a tear ever since, helped by increased capital investment budgets from those major customers. The second quarter numbers will be judged against the guidance provided by Mr. Wang back in May. For the second quarter, revenues of around $45 billion, a gross margin of around 72%, operating expenses of $5.7 billion, other income of $450 million, and a tax charge of around 16.5%. Analysts therefore expect sales of $45.8 billion, up 52% year on year, net income of $23 billion, and headline earnings per share of $1, up 47%. Going into the numbers, the consensus for the third quarter that lies ahead is as follows. Sales of $52.3 billion, up 49% year on year, net income of $27.4 billion, and headline earnings per share of $1.16, up 43%. Watch out for any comments from Mr. Wang on the ongoing US-China trade talks, the deal cut with the Trump White House to receive 15% of all sales on H20 silicon chips into China to the US government, and the lurking challenge posed to the more chips, more power, more capex model that is posed by China's DeepSeek. Thank you for watching. I hope that you and your families are all keeping well, and I look forward to seeing you again next time.